I'm curious to do some skill testing. I feel like I've learned a lot in our past podcasts, and today I know we're talking about really the 3 tips for evaluating target date solutions. So I'm somewhat familiar, but I'm confident I will learn some more about Kathryn. And tell me why you're excited to have Kathryn from T-Row come in. What are you hoping to
Yeah,
get out
so
today?
the topic, as you said, covering target date funds, it's a discussion that we have every day with the plan sponsor when we're helping them choose the right target date fund for their lineup. And then once that's done, when we meet with plan members, when they have to go and pick their investments, we have that discussion. So target date funds are a big part of especially DC type plans, so defined contribution type plans. And no better guest than Kathryn, who really is well versed in this topic. And I'm excited to take a deep dive into their thoughts behind how a target date fund should be constructed and all the inputs that go in it.
Awesome. Well, let's bring her in.
Let's do it.
Great. So let's go ahead and welcome our guests. We've got Kathryn Ferrell, who's a target date portfolio specialist with T. Rowe Price. Welcome, Kathryn.
Thank you for having me.
So what's on the docket today? We have our topic of the day is 3 tips for evaluating target date solutions. So tell us what makes this the hot topic that you want to talk to us about today, Kathryn.
Sure. Well, target dates are such an important asset class, and they're so important to plan sponsors and to members using them as they prepare for retirement. We've really seen a big shift to using target dates as that one-stop shop for members to think about. If I'm only going to use one investment to start building up a nest egg, saving part of my paycheck, with the goal of using that kind of pot of money at retirement to fund my spending in retirement, it's really critical that we're getting it right, that we're designing really strong solutions that can help individuals meet their objectives. And the industry has evolved over the last few decades, where we've seen new entrants to the target date space. We've seen a focus from what is a target date to do I need a target date to what kind of target date do I need? So I think it's a really good opportunity to relook at target dates as an investment and say, do I have the right one? How am I evaluating it? Is it meeting my member needs? So I think for plan sponsors, for advisors, helping plan sponsors navigate this industry, it's really timely to think about diving a little bit deeper onto the target date landscape and thinking about what do I want my target date to do and is it doing it?
Awesome. Well, let's dive right into a plan sponsor question. I know they often think about performance and fees, and when they think about target date funds, and that is it the assumption that all target date funds are the same, or what are some of the ways that target date funds are differentiated?
Sure. I think for an individual, they kind of all seem the same. I'm in the 2030 vintage or the 2040 vintage. I may have been put in that vintage based on my birth year or my time horizon to retirement. But there is a lot more nuance to what goes into a target date strategy. Target dates have a lot of tools in their toolkit where you can think about really one critical aspect of a target date is that level of equity. That's going to be a big driver of outcomes over the long term. If you have more equity, you can think that's probably going to drive more growth over the long term. Again, build up that nest egg to be a little bit larger over the long term. But at the same time, it can come with more volatility along the way. And so you have to think about, well, there's going to be trade-offs to that level of equity. What's going to be the right one for me, the right one for my members? There's also a lot that goes on under the hood when you think about what's underneath that glide path. What types of equity? What types of fixed income? How are they implemented? Are we using active management to try to outperform a benchmark? Or are we using passive management to try and get efficient market exposure? So there's a lot of nuance that can go into the target date solution itself. And different providers take different approaches, designing them to meet different objectives, and then implementing in different ways. So I think you can get a little bit more nuance now than just what is a target date or what is the vintage, but what actually is that target date driving toward, and is it doing it well?
Mhm. And with those nuances, Rahim, from the advisor perspective, what's something that, how do you get plan sponsors thinking about the key aspects that are the differentiators as they start the process of evaluating?
Yeah, it's a great question, and thanks, Catherine, for joining us. So to our plan sponsor audience, just to level set the Canadian marketplace. So Catherine, you're in the U.S. and your market is 10x Canada, but even in Canada, let's say our big five providers. With each of them, you'll have the choice of between, it used to be one target date fund and it was easy to decide, right? It's proprietary target date product presented by carrier ABC. But now you have four, five, sometimes six choices available to clients, and consultants have the job of making sure that we are choosing or helping the client choose the appropriate retirement date fund. So the way we do that is, we really have to differentiate between whether something simple like active passive, what does a client prefer? Are they sensitive to fees, right? Do they want a target date fund that's um, multi portfolio managed, so where all the inputs are not coming from one fund manager? So there's a lot to double click on.
Mhm.
um, but I wanted to hear more about specifically from you, Catherine, is when we talk to plan members, the advisor community, and I'm sure whoever the educators are, whether it's carrier educators or us, we position target date funds as set it and forget it, right? So for the plan member, it's a very simple product to kind of wrap your head around, right? But with that simplicity, there's a lot of complexity in the back end. So maybe help us understand the building blocks or the
Mhm.
input, specifically the glide path, which is where we really differentiate product A from product B. So I'd love to hear your thoughts around the makeup, the DNA of that target date fund, and what can clients think about when they're choosing it.
Absolutely. Yeah. I think we ask a lot from individuals in society, and certainly when it comes to planning for retirement, that's not always their day job. And so, they're trying to do their job. They're, working for a company that offers a benefit like a retirement plan. And a target date is a great solution, kind of take that knowledge of how to think about a glide path, how to pick an asset allocation, how to make that change over time, and really think about how can you drive those long-term outcomes and really help do that for the member. So it's certainly a critical tool, I think, to help members again not have to spend the time, the bandwidth, kind of thinking about these portfolios and maintaining these portfolios on an ongoing basis. So when we think about getting that level of equity right, that's really critical for the multiple market cycles that a member will go through, the multiple generations of members that are going to be using these portfolios. If you think just about an individual starting their career around age 25, preparing for retirement, we'll say age 65, that's 4 decades that we want to think about getting that level of equity right. And then beyond retirement. Retirement's a great day, certainly an important milestone, but it's not a single day that someone needs to plan for. It's again multiple decades when you think about life expectancy past retirement. So for us, getting that holistic view of someone's lifespan and then saying this is the right level of equity based on the objective of maintaining your standard of living, where we think it's really critical. The target date solution in our view is there to help members eat well and sleep well in retirement, which means maintain that standard of living that they're used to from their working careers while they're in retirement, and then not run out of money. Have that money last for all of their retirement spending needs during that journey throughout retirement. So when we design the level of equity, we have to think really critical about asset classes, certainly stocks versus bonds, how they behave, what will they look like over the long term, but also the behavioral aspect of a target date, where you're investing part of your paycheck, every time you get a paycheck into this investment, and again you're preparing over decades for that retirement outcome. So it's this behavioral aspect that we need to think about as well. So thinking about really your earnings profile as the benchmark. That's the bogey in terms of spending that we want to recreate, minus your savings, minus your taxes. that level of spending that's left over is what we want to make sure a member can maintain throughout retirement. And that varies across individuals. If you think about individual members within a plan, they have different earnings profiles. If you think about members across plans, they have different earnings profiles. They'll have different savings rates. And so we have to think about that all in the context of there's going to be a range of individuals using this tool, this target date strategy. So how do we solve the needs of this diverse population? And really that's kind of thinking beyond averages, right? We don't want to just plan for the average member and get the average member to success, but think about the range of individuals using these and make sure we can get the most members possible to a successful outcome. And they'll have other sources of income. I think that's one of the unique things that we do in our modeling is thinking about OAS or CPP or QPP. That's another source of income that members have available in retirement. But that's, again, going to vary across the member base. Based on your earnings level, lower earners will actually get more of their income from those pension benefits versus higher earners, as a proportion of your income, they're going to see less replaced from that. So we want to think, again, about the diversity of the profile and how do we get all members to a beneficial outcome, with the level of equity being a meaningful driver that we can use to drive growth in their account. So that's, again, kind of some of the nuances that we start to think about in designing this for the Canadian member population.
Mm-hmm. So I have a bit of a follow-up question. I'm always putting my hat on to think about, the plan sponsors or plan members that may not even be part of a plan today, right? That small to mid-size business owner market. So let's see if I've got my knowledge on point here. So target date, as you said, someone joining a company, you're 25 years old. What's in front of you is a menu, and it's a timeline. So you're going to pick basket number one, could say, I plan to retire when I'm 60, or I plan to retire when I'm 70. And after I make that choice, the fund itself does the work. So it starts out aggressive in the early years and then would get more conservative. Do I have that right?
Wow, Caroline, you could take my job any day of the week.
Well, I listen to the great advice. I learn a lot in these podcasts. So I hear about target date funds, and I'm in some as well. So that's good. Well, I should really just be in one, right? I should have one.
Unless you're planning on retiring in multiple time periods.
There's semi-retirement, but anyways. So that's one aspect. So I wanted to make sure listeners, in addition to myself, had that clear as to what exactly it is. And I do want to come back to, it sounds like within the offering, it's not only picking the date, but what you just said, Kathryn, is it's taking into account your spending rate, your total income, high versus low versus medium, that there's actually an input that's going to help put you in a sub basket. Is that how I would describe that?
Well, I think that's the nice thing about a target date strategy, that it's kind of a blunt tool. It's designed for all members to use and to use relatively easily. Where to your initial comments, you really just pick the year you expect to retire. So we'll say 2050, and that is going to be the date where you can think, my portfolio is going to continue to adjust. It's going to continue to, as you mentioned, start out more aggressive earlier in your working career, have more in equities. Your account balance will be pretty low then, and you've got a lot of time on your side. So that higher level of equity will really be driving growth in your portfolio, growing your assets. As you're saving paycheck over paycheck, building up that pool of assets that really you're planning to start using after the year 2050. It'll get more conservative, though, as you get closer to the year 2050. So as time goes on, that level of equity is going to automatically decrease on your behalf. So you don't have to do anything. You've picked the year you want to retire, and then the target date portfolio, or the manager of the target date portfolio, is going to change that on your behalf. It's going to think about all the nuances of someone using that 2050 portfolio and try to make sure that it's delivering the right outcome for you to start using those assets then and use them throughout retirement. So again, you don't have to think more beyond kind of just the time frame of when you're going to be retiring. You want to save as much as you can. You want to do a lot of other good behaviors on your own. But in terms of figuring out how you should invest your money, that's really the sole job of the target date, is to help say, this is the one-stop shop for you to say, this is how much in stocks, how much in bonds, and what else goes on under the hood. But to take that lift off of you and to say, you just pick the year you want to retire. we'll do everything else on your behalf.
Perfect. And Kathryn, another question. Just while you were talking, I was thinking about it. I know T. Rowe Price has a record keeping business in the U.S. And do you have access to data? I know a lot of the data we get in Canada shows that target date take up with plan members it continues to go up. I'm assuming that is the same in the U.S. as well.
That's right. Yeah, target date adoption, there's been a lot of um, regulatory support for default investments in retirement plans in the US, where plan sponsors have some kind of protections for saying that I'm going to automatically enroll members into a plan and I'm going to default them into a target date.
Right.
Roughly, I think 96% of the plans across record keeping platforms in the US are using a target date as that default investment.
BQIA.
Exactly, the
Yeah.
QDIA, the
Yeah.
Qualified Default Investment Alternative. So we even have a term for it, and that's driving a lot of adoption. And there's so much inertia with retirement plans that typically once an individual is enrolled in a plan and invested in a target date, they tend to stay there. So that's why
Yeah.
we've seen target dates really grow very meaningfully within the U.S. It's those adoption provisions and kind of that default nature of investing for retirement. And again, I think that's a good thing where we look at kind of acceptance of target date, we look at also behavior throughout market cycles of participants in target dates. And what we tend to see, which I think is again a really good thing, is that there's not a lot of trading. So when we look kind of at kind of early volatility like we've seen in the market so far this year in 2025, markets have been swinging pretty widely. And a do-it-yourself investor, they can be a little bit more inclined to maybe be a little nervous about that and potentially trade. And the worst thing that they could do is sell out after a market downturn and lock in a loss and
Yeah.
then miss the subsequent rally if markets recover.
Yeah, I think we saw that during COVID. I think there was a study, I believe it was by Vanguard, and it showed, you know, people that had target date funds, as you said, Catherine, very little trading involved. They continue to plow in, make contributions. So I think it's a great solution for plan members because it's very long term in its nature. From a behavioral perspective, you feel calm about it. But maybe talk to us a little bit about from a plan sponsor perspective, like what can they take away as that one remaining thought about this discussion that we've had.
Sure. I think take a look at what you want to do with your plan and make sure that your target date is aligned to deliver that outcome. So think about again all the tools that are available to target date managers, the level of equity, the types of equity and fixed income, how they're implementing it, and make sure that you understand the value for cost that you're getting within that solution. Certainly, we talked about performance, we've talked about fees, but importantly, again, think about outcomes. Think about the outcome that you want to deliver for your member and make sure that the target date solution you're selecting is really aligned with that goal.
So I've got a plan member question because I think about in today's world, my daughter's soon going to enter the workforce at some point, and she could be that, 25-year-old choosing her target date fund. But the reality is, yeah, she may work at a few different companies. So do you find some apprehension, and maybe this is more for Rahim, but how do you help a plan member have the confidence to go ahead and join something knowing that perhaps that employer or their choice of employer could change and they move in and they want to be sure of what they can do with that? Is there something that they could fit into in the next plan and when they're transferring it over, or on the flip side, bringing in, right? Someone that's in their 30s or 40s coming into the company. How do you help plan members navigate that switch?
Sure, it's a lot to navigate when you're starting your career, so that's very exciting.
Mhm.
I think getting them invested, getting them not just kind of putting money in cash or ignoring it and not saving it, that's the most important thing. So enroll in your plan, make sure you're saving a meaningful amount. If there's any sort of employer contribution, make sure you're getting the most you can from that. And really stay invested. I think kind of regardless if you're staying with the company or you're switching company, while you're working, while you're earning income, make sure you're putting part of that away and make sure it's working on your behalf. So keep it invested, look at the offerings that's available through the plan, and make sure that you're preparing for that goal of retirement where you don't have to work any longer. It may feel like a long way off, especially if you're just starting out, but still start putting the money away for that purpose as early and as often as you can.
Yeah, and just to add to that, I think Caroline, you'll find that depending on the type of plan, you almost have the option of portability. You go from employee A to employee B. It's likely that they offer target date funds that may be either the same or something similar. So you have the ability to to transfer, not in kind, like it'll be a cash transfer, but you can easily go from one target date fund to another. And from my experience as a consultant, and when we do a deep dive 1 year later, that a plan that we've just implemented or taken over, and we want to see, did our education make a difference? One of the gauges that we use is, what was the target date allocation in the plan, let's say Jan 1 versus December 31st. And almost always we feel that when you educate and you give plan member the choices between a standalone U.S. equity fund and a standalone bond fund, and then a balanced fund, and then a target date fund, they almost see it as an evolution. I kind of phrase it as the best technological enhancement our boring industry has, right? So the 1.0 was a single manager equity fund, and then we got smarter. We came up with the balanced fund, and then we came up with an asset allocation fund that looked at things from a risk perspective, but you still had to follow it and make sure that you change your risk level as you may get older. And then you have target date, where it's literally set it and forget it. And as Kathryn mentioned to us, you're running 100 million different simulations, and before putting things together, I'm not gonna call it, what type of simulation, but you do a lot of work. Record keepers or target date providers do a lot of thoughtful work in putting together a solution that very, very robust on the back end, but so easy for a plan member to choose, and then they're hands off if retirement date isn't changing, right?
Yeah, makes sense. So there's one other term that you've been saying, and I want to dive into a little bit to make sure we understand what that is. When you talk about glide path, talk to me about that.
Sure. So the glide path, it sounds like an aviation term. I think that's that's what it's got me think of a plane landing and having a smooth landing at the destination. So if you think about the destination of retirement, that's really going to be in reference to that level of equity coming down. So again, when we think about the main risks that an individual faces is really longevity risk when it comes to retirement. They're going to work to save up this pool of assets, but if it doesn't meet their spending needs or if it runs out, that's a crash landing, right? That's not success. So you want to think about that glide path or that level of equity as helping to drive meaningful growth for the long term. So having a meaningful level of equity, that's going to really help a member prepare for and go through retirement, get to that landing point, but then have success throughout retirement where they can maintain that spending level that they need throughout the rest of their life. So glide path is really talking about the level of equity and how that shifts over different age cohorts or different time horizons. And different target date providers think about it differently. I think T. Rowe Price, again, we really focus on the challenges that we see individuals face preparing for retirement. We see they don't really save enough, but life expectancy generationally has increased. So they aren't saving enough, but they need more money to last throughout lifetime. We want to try and bridge that gap. And the level of equity from the glide path is going to be a meaningful way we can help from an investment standpoint. So if we can give a higher level of equity when you're early in your working career, you got a lot of time on your side, and then even as you get to retirement, you still could have, multiple decades ahead of you in retirement. So we don't want to kind of give up the opportunity to continue to drive growth when you have pretty high balances and still a long time horizon in front of you. Mm-hmm. So our view is that glide path and having a higher level of equity than what may be typical in the market is going to be a way that we can help really, really address some of the risks that members are facing for that milestone.
So that member experience, that's one of the, glide path really drives the overall returns. What else is going to be a factor that helps, determine that member experience?
Yeah, it's a great question because the level of equity certainly matters, but I think the types of equity, the types of fixed income also matter. Those are really important to driving durable, consistent outcomes throughout different parts of the market cycle. So if you think about the global opportunity set of investments, it's pretty massive. There's a lot out there that we could invest in. So when you think about kind of the stock sectors or the fixed income sectors that could be in a target date solution, having a broad exposure to different types of equity, different types of fixed income, that can help to really be more effective at driving growth or to mitigating different types of risk, like interest rate risk or market risk. There's a lot of things that we can use within that kind of diversification of the implementation of a target date portfolio to drive better long-term outcomes.
Great answer.
Yeah.
Caroline, are you an expert now or what?
I feel it. I feel like we've talked about, glide paths, target date funds, all the things that, at the end of the day, it's helping plan members choose wisely, right? You are guiding them and you're providing these tools and insights that will help, remove the stress of it all, right? Because it
Yeah, it's
can be
kind of like
overwhelming.
defense and offense in
Mhm.
one product, and it's easy
Mm.
to understand. It's great that we have a solution like this, and I think we're probably going on 10, 15 years now, and I
Mhm.
think the numbers in terms of utilization will continue to go up, which is a good thing.
Mhm. And I think from a plan sponsor perspective, I think about you've removed the the temptation from employees to kind of buy and sell and feel like they need to be active in it. You've helped them make wise decisions with a product that really does remove that variability. Like you said, it's the
Mm.
market's always going to have times when it's highly unpredictable and scary and people want to sell, and then, as you say, most times when people put their hands on things, they're going to miss the upswing opportunities. So I like that in these scenarios it sounds like the plan sponsor has done their best to put in a solid product for retirement, for helping that glide path and land safely. And then as an advisor, there's still a lot of complexity there, though, when people have their questions or wanting to understand, should I choose the 2030 versus the 2050 and what does that all mean and what's inside that? So keeps you busy, Rahim. It's not a set and forget it entirely, I can imagine.
Yeah, yeah. The different vintages, as Catherine mentioned earlier, you pick the fund that lines up with your retirement date, and if
Mm,
that's not changing, it shouldn't either. I think the one negative I would say that we find in our experience, and it doesn't happen all the time, but we should, while we're having this discussion, think it through, is the assumption that the target date fund makes that all young investors are comfortable with the level of equities that we put them in, right?
mm,
So, I've had, I wouldn't say too many, but definitely where I can count on both my hands, where I have a plan member that says, hey, you know what, this sounds great. But I don't feel right being in almost 100% equity or equity like allocation because my risk profile it doesn't work with that, even though I know I'm going to be in a tax sheltered environment where I don't need the money for 45 years. So we go through all of that, and for that individual, I don't think it's ideal, but maybe they work with the different vintages that are available. Like maybe they don't buy a 2060, maybe it's the 2040, right? Depending on the allocation, or it may just not be a product for them, right?
mm,
So I would say for the most part, it will work for 9 out of 10 plan participants, and for the individual that doesn't work, we can make it work, or they can figure out a different way to structure their portfolio. But it has been a game changer for DC plans because we've never had a solution like this,
mm.
you know, 10 years ago or 15 years ago.
Yeah. You just touched on something there, Rahim, that made me, think that, of course, most people will have a variety of investments or savings in different vehicles other than perhaps just their employer plan. So, depending on the level of risk those other bundles are in, could impact what target date they're choosing, as you said. But for the most part, it's it's a good guide for people coming in. Any final thoughts or comments, Kathryn or Rahim? Like what you would want plan sponsors to be aware of if they're considering implementing a plan or have an existing plan when it comes to target date funds?
I think we talked a lot about the main drivers, thinking about the level of equity. That glide path discussion was really robust, where we thought about that's going to be really aligned with what plan sponsor objectives are. Kind of if you're thinking about, I want to help members replace income, going to need some equity to do that. And also, I'd say think about the value for cost that you're getting. When you think about, kind of again, the opportunity set to invest across different types of asset classes under the hood of a target date, active management can be a way that you can get broader diversification, where there's some asset classes that you can't or maybe wouldn't want to use from a purely passive implementation standpoint. Utilizing active management at a reasonable cost, that can help give you, again, a broader opportunity set within a target date solution. And then pairing it with some passive management can help to do that at a really attractive fee profile. So kind of that idea of potentially getting the best of both active management and passive gives you that broad diversification, a lot of levers within the target date solution, but again, at an attractive value.
And that lines up perfectly with the new CAPSA guidelines, right? Which are not entirely fee focused, and the value for cost is right on the nose. It's a perfect thing to say, and it lines up with the new CAPSA guidelines, and how they want plan sponsors to look at funds, where it's not all about fees. Fees matter, but holistically the solution has to be the right one for you.
Awesome.
So great answer, Kathryn, and thank you for joining us today.
It was my pleasure. Thank you.
We'll see you again. This has been the Benefits Alliance Voice. If you enjoyed this episode, please share it with your network and be sure to check out the podcast notes for any additional materials.